Before I start, little disclaimer, everything which I tell you, you can't sue me on, okay? It's not investment advice, it's not financial advice. I'm going to show you some charts and some trades that I may have taken, but do not copy them. Past returns do not indicate future returns, blah, blah, blah. Don't sue me, okay? All right, fantastic. Cool, so who am I? So I was the vice president of the society last year. I'm the vice president again this year. I launched the Alpha Fund last year as well, and that's going to continue this year. I write for the Student Investor. If any of you want to write for the Student Investor, send us a message. It's read by over like 3,000 people, over 100 countries, since David, the last president, set it up. Pardon? 20,000. Wow, cool. What experience do I have doing trading? Well, my uncle is the head of technical analysis at UBS Investment Bank. I do speak to my uncle. We have a few conversations about trading. I've also read quite a few books on it. I got a few friends who do it. I've also got a company that does algorithmic trading. So supposedly I know what I'm talking about. Fantastic. So before we dive into the fundamentals of technical analysis, I need all of you to really understand where it comes from. Okay, what are these little price movements on the chart actually represent? So this is literally straight from my math finance lecture. I do math, by the way. Straight from my math finance lecture explaining what a share is. So say you're Elon Musk and you need to make a factory to make your cars. How are you going to pay for your factory? Okay, anyone know how you're going to pay for your factory? Go to investors, or you can also go to a bank and raise it through debt. We'll talk about raising money through equity and debt next Monday. So you've gone to investors, that's literally like people, you and me, and you've decided to take the punt and invest in the company. What you're essentially doing is sharing the company between lots and lots of different people. Okay? If you share the company, you have shares. That's where the word comes from. Yeah, stocks and shares. You have dividends for taking on the risk of being a shareholder. A few of my favorite companies are tobacco companies, and they pay about 8% dividend. So that's like having 8% interest through a bank. Needless to say, they're pretty good. Cool. So now I've got that out of the way, you know what a share is. What is technical analysis all about? Or really simply, it's just about the study of price. Okay? The price of a share, a company, a commodity such as oil, gold, cryptocurrency. You know, how many people know Bitcoin, Ethereum, right? All those sorts of things, if they can be traded, they're going to have a chart related to them. This chart is essentially indicating fundamental investors who look at the fundamentals of the company. So they're interested more about how they can help the world. Can they grow? Can they be profitable? Who's the CEO? Have they got a competent team? All those sorts of things. And they just use a chart to decide when the best time to invest is. Okay, usually you don't want to buy high and sell low. Okay, you want to buy low and sell high. And me personally, all the data that you get from candles and charts, you can feed them into an algorithm. The algorithm can do some data analysis, and it can be automatic. Fantastic. So what are tickers? Like really, really simply. Tickers, when you go onto Google, you can go on Google right now, type in your favorite company, okay, and write Apple and then stock. It will come up with the ticker name AAPL. Okay, it's just an abbreviation that traders use to trade these things. On the left of it, it says NASDAQ. Does anyone know what the NASDAQ is? If you do, shout out. Yeah, it's the US tech companies. By the way, we're giving away books and notepads. So if you want to win some today, if I ask you a question, you get it right, you can win some notepads and books. So that's right, the NASDAQ is simply the second largest stock exchange. An exchange is a marketplace where stocks and shares and financial assets and securities, anything tradable, can be traded. Okay, you go to that marketplace, so you go to your favorite shop, let's say ASOS, right, go to ASOS, you buy from there, or you can buy the same thing or slightly different things from a car company, right, Tesla, whatever. Okay, so I told you all to bring your laptops because I want you all to, right now, go on Google and type in TradingView. Okay, TradingView is by far, in my opinion, the best charting software when it comes to charts. Okay, you don't have to make an account. It's free to use, or there are different tiers of pricing depending how into charts you get. It's a social network. It's got community back behind it, and obviously it has increased functionality. If you're a programmer, you can backtest your strategies, and that's what TradingView is. And all of my screenshots are from TradingView. Okay. All right, fantastic. So TradingView, if you type in the ticker AAPL at the top left of the corner, you'll see a chart that looks similar to this. I made this presentation in August 2016. As you can see, the most recent price was August 2021, sorry, August 16th. And I've actually did some analysis on these charts, and we can see if my predictions were correct later on. So there are a few things I want to point out that you need to know about when using TradingView. This is just the basics. Top left, you've got the ticker, Apple. On the right-hand side, the price. So each share is worth, in August the 16th, 2021, it was worth £149. Okay, you can look at how much it is worth right now. It's going to be a bit more. Cool. So you've got the ticker again.
Apologies for the sound.
Apologies for technical difficulties. Wait. Oh, okay, fantastic. Okay, so the charts have candles associated with them. Okay, the candles are the things which are actually important. They tell you the price. Okay, a lot of forex traders, the people you see on Instagram, they talk about price action. That's a fancy word for the movement of the price, day-to-day fluctuations. You've got hollow candles and you've got filled candles. Okay, the hollow candle means the close was higher than the open. Don't worry, I'll show an example. This is just some theory and just some key characteristics you can see on the screen. The low price is the bottom of the wick. The high price is the top of the wick, and the body of the candle just shows you where it was opened and where it closed. Okay, so I've zoomed in onto Apple's chart on TradingView just to highlight my point. Okay, but I'm going to ask you a question. If this is the close price and this is the open price, okay, and because this one is empty, that means it closed below the open. So that's the close, that's the open. How come they don't align? How come the open of the previous one is not the open? How come the close of the previous one is not the open of the next one? Surely, I'll take your question. I'll take the answer in a minute. Surely, if the price closes at £100, literally it should open at £100. Why are they not aligned? Put your hand up, shout out, whatever you want. Yeah, so the stock market, or the NASDAQ in particular, it's not open 24 hours a day, 7 days a week, right? Investment bankers need some sleep, okay? They can't be trading 24 hours a day, 7 days a week. American markets, there's set time intervals when they're open. The UK one is open from 8 a.m. and closes at 4 p.m. So if you want to be a trader in an investment bank, you'll get there quite early, 5 or 6 a.m. You go to your briefings, your morning briefings, and you'll be home by 5:30, 6, because if the market's closed, you can't be making money. Okay, if you're an investment banker on the advisory side, right, your job's 24/7. So 2 types of investment banking: the people who trade, and the one that do mergers and acquisitions. Yeah, you want to be a trader. Okay. Depends how good trader you are. Okay. Cool. That's a bit blurred. I'll just move on. Okay, so one of the first things that, if you're really new to technical analysis, you learn about trend lines. Okay, you may have heard this saying, the trend is your friend. Okay, think about a stream of running water, and you drop a coin or a rock into the stream. Do you want to be the person that tries to, run up the stream, or just sit there and allow the stream to move you forward? Okay, you don't want to. You can, and people do it. If a stream sometimes, I don't know, I don't do geography, but somehow a stream could start flowing the other way. They're very, very rare. You could predict them. They're very hard to predict because you can't predict the future. However, if you're doing what everyone else is doing and following the trend, you tend to do quite good. Also, if you've got any questions, anything that I'm saying doesn't make sense, just tell me, okay? Okay, so this was on the trend lines, which I drew just using TradingView. On the top left, on the left-hand side of the screen, you've got a column containing tools. One of the tools is the trendline tool. At the end of the session, I'm going to actually do one with you. So you know all the buttons I'm clicking, and you know exactly how to do it. You'll do it with me at the end. So the blue line is just a trend line. Okay, how do you make a trend line? You join a few points on the chart together. There is no exact way there's no perfect way, just like art, there's no perfect way to draw a trend line. Okay, it's very subjective. Different people see different things. All you want to do is try and connect 2 points of the chart together. Who here thinks the steepness of the line affects its credibility? Put your hand up if you think the steepness of the line affects how good it is. So steeper bad or steeper good? Steeper good or steeper bad?
Steeper generally is, if it's more like vertical, it's generally bad.
Good. So trends, if it's a really bad storm, it's not going to last very long. Right? If the price starts going parabolic, you'll have a very, very steep trend line. Right? Just like GameStop, Dogecoin, they went parabolic. The trend line was really steep. Usually, they're going to crash. One more thing about trend lines. If the candles fall below the trend line, so they don't respect the trend line, that means you're fucked, right? So if the trend is your friend, okay? If you're doing a trade and you're trying to bounce it off the trend line, it can work, but in the times that it doesn't work, it can go really, really horribly wrong. So you've got to be careful with technical analysis. When it works, it's great. When it doesn't work, you can lose a lot of money. Okay, so this is just quite a steeper trend line that I drew. And say you drew that trend line back in March of 2021, and you wanted to take that trade at the very end of it, just to emphasize my point. If you took the trade when the price was about $130, it's dollars because it's on NASDAQ, it's all American. If you took that trade at $130, banking that it would bounce up, well, if it was leverage, you're going to lose a lot of money. Leverage just means if you leverage up 2 times, it means you put £100 on, and basically you're playing with £200. Okay, that's what leveraging means. And getting leverage is very easy. Anyone can get leverage, but it means your losses are also amplified. So your losses, if you win 200 times, you're going to lose 400 times. Okay, support and resistance. So support and resistance are another key idea of looking at charts and thinking about technical analysis. So a resistance, you can think of it as an influx of people who are selling. Okay, at the end of the day, the thing that makes the chart go up and down is buyers and sellers. Okay, it's supply and demand. If there are lots of people wanting to buy the stock, the price increases. If everyone gets panicked, like they did in 2008, and everyone starts selling, the price crashes. So really, charts are quite psychological. And you do psychology, literally, it's just a herd of people moving with the noise, the news, everything. Okay? So support and resistance, I'll show you an example to clarify. Okay, so a lot of people, they draw lines of support and resistance. Okay? What you want to do when you draw these charts, when you draw these regions, I call them, you want to draw them as boxes. Okay? The boxes give you a region of uncertainty. Okay? It's very unlikely every single point is going to be perfectly touching a line. However, it's more probable that they're going to be within this region, this purple region here. So if you looked at it in August 2020, and you notice there was a peak there, quite interestingly, in December of 2020, in January, it didn't break through the peak. Because it didn't break through, it's a resistance line. Okay, it's resisting people, it's resisting its price to increase. Who knows the reason why there was a very, very sharp red candle basically at the peak of this box? Who can tell me? Why didn't the price just fly through it? Just shout out if you want to. Why didn't the price fly through over here? Exactly. There's a lot of algorithms in the market, right? These algorithms are there 24/7, running in the background on servers that are underwater. And when the price hits there, they'll take profit. Taking profit means a lot of people are selling. If a lot of the people are selling, it creates a downwards pressure on the price. Okay, it makes sense, right? Okay, cool. And really, it actually really respected it. It did go through it in April 2020. But really, throughout a year, it didn't go through this resistance line. Okay, so regions of resistance are quite powerful when it comes to looking at charts. It absolutely destroyed it recently in July. What's the reason? Why did it break through in July? What happened in like July, May, June, July, August of 2021? Anyone? Go on. New iPhones? Ish? Anyone else? Yeah. It's basically to do with COVID, I think, my fundamental theory. A lot of tech stocks boomed in July. There was a lot of uncertainty. So over here, back in August 2020, when there was lockdowns, it basically went parabolic. There was a correction, and July, August of this year, people actually, well, the head of the Fed, Janet Yellen, she didn't say there's going to be a reduction in their monetary policy. So the amount of money the US government are pumping into the economy, okay? That's the reason it's going to keep on going up, I think. Okay, so trend lines, resistances, they're useful to know, but they're pretty easy. And what you've got to realize, if it's this easy, a lot of people are looking at them. Okay, it doesn't mean they're not useful, it just means that everyone's looking at them. So there's more things that you can use, and these things are called technical indicators. So technical indicators further help you analyze charts. I wouldn't say they're that hard to use. The equations that underpin them aren't terribly difficult. I do a maths degree. Most of these technical indicators, the math behind them is like primary school GCSE level. It's like averages. It's really not hard, the maths behind all these indicators. Okay, so looking on TradingView, if you look at the toolbar at the top, you've got a button which says indicators. So you click on indicators if you want to do that now, and they'll give you a drop-down chart of all the ones that you can have, right? There are thousands of indicators. They're not hard to produce, and anything can be an indicator, essentially. What I'm going to show you are the two, I think, most useful type of indicators, and they're called moving averages. So if you type in moving averages or exponential moving averages, you'll be able to find them, and I'll show you examples later on. So simple moving average, right? This is probably the most widely used one in the whole of the industry. And look at the formula, right? You add some things together, you divide by how many there are. It's literally an average. Investment bankers are using these things to make a lot of money. So a 50 moving average, a simple moving average, literally you get the 50 most recent prices. You can choose whether you want the open, the close. By default, you probably choose the close. And you just divide them, right? It's literally as simple as that. Okay, so on TradingView, it's not called simple moving average. They take away the word simple, and they just call it moving average. So you can add them, and I usually do it in a rainbow. So a rainbow goes, everyone knows how a rainbow goes. So the ones that I put on this chart of Apple is a 50, 100, and 200 moving average. They help you identify the trend. Okay, if there's an upwards trend that you see over here, they're in a stacked position. Okay, when the price moves below the 50 moving average, people start to get worried. Big banks get really worried, and that's why the price dipped here. It breached the 50 moving average. It breached the 100 moving average. People got really nervous, kept on selling. It got pretty low here, and then people realized, wait, it's Apple. They're worth trillions. They're probably worth more than Greece, right? And so they kept on, it changed direction. Okay, fantastic. Any questions about simple moving averages? No, cool, easy. All right, so yeah, they're the moving averages. All right, don't worry about this formula. If that looks a bit scary, it's not, but it's just looks a bit scary. You have these things called exponential moving averages. Exponential moving averages are basically simple moving averages, but they just have more emphasis on recent data points. So with short-term fluctuations, the simple moving average isn't going to care. The exponential moving average is going to track it a bit closer. Cool, so let's see them on the chart. Before we do this, this is from Simon Ree's book, The Tao of Trading. It's how this guy called Simon Ree, who's been doing technical trading for like literally 40 years, this is how he identifies an uptrend. So an uptrend is if they're in a stacked rainbow motion. He uses exponential moving averages to identify the trend. And as you can see, you can read, in a very strong uptrend, the price will find support about the 8 EMA, in a strong uptrend, the 21 EMA, and a moderate one, the 34 EMA. Essentially, all you need to know, if it's Dogecoin, it's going to be 8 EMA, and if it's a normal company, it's going to be more along 34 EMA. All right, so Apple is a tech stock. The tech stocks, I would say, are in the same bubble at the moment as crypto. So what have we got? We've got all the moving averages, which were on the previous screen, in a rainbow motion. So over here, they're lovely and stacked. Okay, here, people get a bit nervous. Something fundamental may have happened to the company, or some macroeconomic event which you can't predict. But really, the trend is your friend. If they're in a stacked motion and it's hugging the 8 EMA, very, very unlikely for it just to crash. You'll know if it's going to crash if it starts crossing all the moving averages. Okay, so one potential trading algorithm or just trading technique that you can use is if the price falls below the red line and it falls below and it crosses the green line, for example, that could indicate, get out the market. It comes back up, you buy low, you buy when they cross again, and then I did buy there, by the way. You buy when they cross, and then you sell when they cross again at the top. It's just called a crossover strategy. I've got an algorithm that runs 24/7 simultaneously with lots of crypto, lots of stocks that are volatile, like tech stocks, and it's looking for these crossovers. Because if you think about it, when they cross this way, that's a good, and when they cross this way, that's also good. Because you can make money if they go down by shorting, you make money as they go up, right? Now, does it work? I think it works. I put a lot of money into it. But the question is, what exponential moving averages do you choose for the crossover strategy? Why do you use the 8 one? Why do you use the 89? Right? So it's all personal preference, what 2 lines you choose to take trades. But as you can see, right, it looks pretty good. You sell when they cross here, you buy when they cross there. You sell when they cross there, and you buy there. So right now, you'd be in a lot of profit if you kept the strategy, which would have worked for the past 2 years, and at the moment, you're in profit. It works for anything volatile, right? Anything which is like crypto, oil, gold. It's not going to work for things which are horizontal, okay? All right, live demonstration time. Before I do the live demo, are there any questions? Yeah. Yeah. Pardon? Yeah. Yeah. So, okay, I'll show you. All right. So I'm going to go on to TradingView. Let me maximize that. No. It is. Using Brave browser. If you didn't know, Brave browsers are way better than Google Chrome. It means you don't get adverts on anything. So you can use YouTube with no adverts if you use Brave browser. It's absolutely amazing. Amazing. Right, so you type into Google or the search bar, you just type in TradingView. Fantastic, and it comes up straight away. Okay, so there's a lot of noise on the front page. All that you really care about is the thing that says chart over here. Okay, so at the moment, for some reason, I've got Bitcoin up. Why have I got Bitcoin up? It's here to remind me to use it. Bitcoin is a 24-hour market. The currency markets don't close. That's why the close of one is the open of the other. They're in line with each other because it's a 24-hour market. To answer your question, why are some of the green ones filled? Well, here they're not, but in the other one they were. If it's filled and red, it means the close price is above the open price. So for example, this one, it would have opened here, and it closes down here. If it closes below the open, it's filled in. Now, do you really need to know that? Well, there are loads of trading strategies that use filled and not filled charts. Do they work? Maybe. Does any of technical analysis work? Like, raise your hand if you actually genuinely believe technical analysis, looking at support, resistance, moving averages. Who here genuinely believes it actually all works. Put your hand up. Interesting, interesting. Cool. I don't know if it works. I think it works. Okay. All right. Okay. My one might look a bit different to yours. It's just because I've changed the color theme from light mode to dark mode. Okay. I do a lot of programming. I don't want to be looking at a white screen the whole time. So if you go on candles, your chart might look like this, where they're all filled in, regardless if they're red or green. All that you have to do to change that is click on the candle button and click hollow candles. That looks a bit more visually pleasing to look at, and you can really see the price, how the price moves. Okay. Again, you've got the time period. So this is a time series graph for anyone that does physics or maths. You've got time on the x-axis, and you've got price on the y-axis. Now let me show you something quite cool. So I was talking about using a crossover strategy. So let me put these indicators here and show you the crossover strategy. So the one I personally use, I'm going to go to indicators, and I'm going to click moving average. My favorite moving average is a 50 moving average. So I clicked it on there, and it automatically came up on the left-hand side of the screen. I'm going to click settings, and settings, basically, you can change how it looks and how many points it averages up. So what period is it? Is it a 10 moving average? Is it a 20 moving average? Is it a 200 moving average? That's what I'm going to change. So I'm going to make it red. I'm going to make it a bit thicker so I can actually see it. I'm going to change the time period to 50. And I'm looking at the close prices. I said by default, it's probably going to be close. By default, it is close. Cool. So that is the 50 moving average. Sorry. Let me just do this for the people at home on Zoom. Just yeah. Okay. Okay. All right. If you've got any other stuff, by default, it might come up with a blue histogram and some volatility. The way to get rid of all the noise on the left-hand side is by going over to it and clicking the remove button. Okay, if you go over to it on the left-hand side and just click the remove button, they're all going to disappear. It's not the toolbar on the left, it's just the left-hand side of the actual chart over here, just below the broker information, the buy and the sell price. Okay, so we've got the red line, which is all about simple moving averages, which means it's not caring about short-term fluctuations. And I'm going to add an exponential moving average. So I'm going to click indicators. I've got them saved, but I'll type it in. So EMA, so it says moving average exponential. You click on it, it comes up on the left-hand side. And I'm going to make this EMA an 8 EMA. I'm going to change to blue, for example, make it a bit thicker. And I'll change to 9, actually. All right, fantastic. So what I can also do, zoom out, so you can see how well this thing actually works. If the scale on the right is the price, it just changes the height of the candles. Okay. Right, so this is literally a 2-year period. This is a basic crossover strategy, which I use. If you used it when Bitcoin not first got big, it got big in 2017. When it got big in 2020, when there was a crypto boom, there's a crossover, okay? Imagine buying at the point at which it crosses over. You buy in at basically 0, and now it's worth 60,000, okay? I didn't know about crossover strategies until about over here. However, I've been using them from July-ish. So I've caught this price move. I've also caught this price move, okay? It only works on volatile markets, okay? It's not going to work if the graph is very, very horizontal. Now, it's up to you whether you decide to use it as well, and it's up to you whether you agree by using the 50 MA and the 9 EMA. There's lots of other things I use apart from this. This is just one little thing. Right, I'll show you one more thing, and then we'll call it a day. Okay, I'll flick on the Apple chart. And I'll show you how to draw the trend line. And as you can see, it takes a while to zoom out. You can also change the time period. I got to mention this. You can also change the time periods of the chart. So you can look at it minute by minute. In this case, the price fluctuations are not going to be as crazy as crypto. So you definitely want to increase the price. So this is literally every minute. A new candle is made every minute. On that chart, the 45-minute, okay, the candles get a bit larger because there's some more uncertainty. And I can even change it to an hour. So there's an hourly chart. I can change it to 12 hours. So this means a new bar is made every 12 hours. And you can even see some jumps, right? Isn't that a bit, scary? That you could have it closed over there. It's closed over there, and it's opened again all the way down here, right? You open your account and you're down like 15% overnight. And there's nothing you can do about it. It's out of hours trading done by investment banks. So yeah. Why are they allowed to trade? It's unfair, isn't it? It's honestly unfair. They're allowed to do paper deals over the counter, and because to trade you have to have a brokerage account. So either Trading 212 for stocks and shares, Binance for crypto. It's closed off to the public. Only investment banks can do it overnight. We're not allowed. Yeah. Is there a way to bypass that? Not that I know of. Honestly, not that I know of. Investment banks are at a massive advantage. Okay, so let me change this. So I usually use, when I trade on a long time frame. I trade on a 12-hour time frame and a daily time frame. Okay, so the trend line which I drew back in August actually was pretty good. All that I did, and if you can go back, if you took a picture of it, I'll send you the slides after. I drew it from this trough, or the lowest point of this candle, the wick. If you were a bit bearish, that means you think it's going to go down, or you just think it's not going to go as high as everyone thinks it's going to go, you would draw quite a shallow trend line. And maybe you would have connected it in August. Maybe you would have connected it to this point over here. All right. It's actually respected it really, really well. Okay. If for whatever reason you were really bullish, and you thought everything goes to the moon, and you drew a really steep trend line, well, it clearly didn't respect the trend line. this trend line also acts as a resistance line. Who here thinks the trend line gets stronger the more times the price bounces off of it? That's true. It's true for trend lines. However, it's not true for support and resistances. Regions of support and resistance get weaker the more times that they're tested. Usually they might bounce 3 or 4 times, but in general, regions of support and resistance, or the purple bar that I drew before, if it's bounced off it 3 times, it's probably going to crash one way or the other. Okay, I want to show you one more thing, and then I can take questions. And this last concept is so powerful, and it's actually called mean reversion. Mean reversion is extremely powerful. So the way you do it, you want to draw a 21 EMA. I'll do it as well, so you know how to do it. Over here, moving average pops up on the left. Press settings, change the length to 21. You go to style. You can literally make whatever you want. I'm going to make it like bold and red and press OK. I'm going to get rid of this trend line. Okay, and let me zoom in a little bit. So there's something in finance called mean reversion. What it basically means is that the price usually will always revert back to the mean value. And as you can see by this red line, it does a pretty good job. If it moves too far above it, like it did over here, it moved too far above, surprise, surprise, the price comes back down to the mean value. And if there's lots of hedge funds back in the day that used mean reversion religiously. And as you can see here, it works pretty well. There are indicators. Yep, go on. Because there's more powerful algorithms than just looking at the mean that exists right now. I'm talking about back in the 90s and 2000s. Right now, they use regression models. If you do maths, they use a lot of regression models. They try and model the price movements using like whatever. I have no idea. I don't work for Goldman Sachs. And if they shared their idea, then it might not work anymore. So it's all very, very secret. Okay, so mean reversion, essentially, the price always reverts back to its mean value, like always. If it's too high above it, it's going to fall below. If it's too far below it, it will push back up. If you want to learn more about trading and technical analysis, the book that I recommend is called The Tao of Trading by Simon Ree. Okay, he talks about all these things, and we're going to give away this book at the end. He talks about all these things in his book. He's done this for like 40 years. He's seen how the markets change. He's seen how they evolve over time. And a lot of my knowledge actually did come from his book. The first 100 pages, hyping you up, getting you into trading. And then the last 300, you're looking at charts and you're learning about how things work. Okay. I think I've given you the basic of technical analysis. I'm probably going to do another session on some more advanced things like an ADX, RSI, Fibonacci retracements. They're the sorts of things which are a bit more interesting and can make you more money than just looking at resistance, support, and trend lines. That doesn't mean to say you can't make a lot of money just trading off the trend and looking at the moving averages. However, there's a lot of risk involved. And as I said, do not sue me if you lose all your money. The market could crash literally tomorrow, right? The Fed may say tomorrow, no more stimulus for the American economy. There's no more, they could say COVID was all a hoax. This was all wrong. And I guarantee you, if they ever say that, the market will go to about zero overnight. That's why the last thing I'll say, if you do trade, trade using isolated margins. Okay, isolated futures, isolated margin. That means the most you can lose is the money in your account. If you trade without that, you're literally risking like everything. Because if you're shorting something, so you're betting on something falling, you can literally lose limitless amounts of money. So when you actually place trades, when you actually trade using prices, like, do some research and don't just click the green button on whatever app that you use. Okay, isolated margins. That's what they're called. All right, I'll call it a day. Have you got any questions whatsoever? Any questions? Yeah, go on. That's a fantastic question. So my uncle works at UBS. There's a team of 3 on his desk. So I did some work experience with him a couple of years ago. And there's actually a team of 3. There's 2 fundamental analysts, one who's heavy on macroeconomics. He can tell you exactly what's going on in the world and where. There's the other guy who will look at the company and will look at the fundamentals, the valuations, which Ryan's going to talk about in a couple of weeks' time. And together, they decide the best price to enter using his technical analysis. So if you're more fundamentally inclined, you could say, okay, Facebook's a great buy. It's amazing. I'm going to buy it. But you can use these technical indicators and technical charts to find the best price to buy at. Also at investment banks, there's a quant division. The quant division are a bunch of mathematicians and computer scientists that create automated algorithms to trade the markets. They will probably only use, they won't care about what's going on in the world. They won't care about who's the American president. They won't care about what war's happening. They'll literally just trade the prices. And if you're interested, I'll 10 seconds on this. The way algorithmic trading basically works is as follows. You get the data, okay? So you go to Binance or something. You read the data into your script. It could be Python, Java. It won't be Java. It'll probably be Python. You read the data in. What data are you reading in? Well, it's just a bunch of information associated with each candle. So the open price, the low price. And they give you a lot more information than what is just available here. Some of the numbers which they give you, they don't even explain in the documentation what each number is. There's literally, here there's what? Open, high, low, close, that's 4. When you read the data into your Python script, there'll be like 50 per candle. Right? You're getting more data than what's available. If you can find some sort of pattern, right, then you'll make a lot of money because other people literally can't see it. That's why an algorithm's, in my opinion, better than this, because they're seeing things which you literally can't see. So you read the data in, it probably comes in as a string, and you do computer science. You convert it to a number, do some data manipulation, so that's where the logic comes from. That's the hard part. And then some condition could happen, so some crossover could happen. And you say, if the red line above the blue line, it's harder to say in code, right? If the red line is above the blue line at this point in time, send a buy order to your exchange, and it will do the order for you. Similarly, it can sell it for you and whatever you want. And it does that using an API key. It sounds a bit nerdy. It just sends and receives the data between your account and the exchange's account. Cool. So that's like a mini bit on algorithmic trading. And any more questions before we?
What software do you use right now?
I use Python. Python's the easiest language you can learn in your life. When I say the hardest bit is the logic, you might come across a lot of things on the internet which say coding's easy, anyone can do it. The actual logic of programming is extremely hard. And that's why quants get paid millions in investment banks, and they're probably the team which makes the most, because they're literally doing things which regular people who don't know about computer science, who haven't been coding for 15 years, they can't do. It's really powerful. It actually is really, really powerful. Did I answer your question? Excellent question. How can the past performance indicate future returns? We've all gone onto financial websites, and every single one has a disclaimer at the end saying past performance doesn't indicate future performance. Technical analysis chucks that out the window and says, well, it does, right? And that's why when I said who genuinely think it works, only a small number put their hand up, okay? I think it works because there's a lot of buyers and sellers in the market, and when something goes terribly wrong, everyone will follow each other. When something goes terribly right, everyone will follow each other. It's literally like a herd of people moving along. And you want to be in the herd when it's going well, and when it's not going well, you need some sort of system, not necessarily a stop loss, but you need some sort of system to say, when it gets bad, sell. But there's one sort of caveat to that. If the market gets so bad, where there's literally no buyers, so in 2008, when it crashed, there was no buyers. And that's why the price literally went down like 70%. If there's no buyers and you haven't done isolated margins, you are the market. So passive index, if the market crashes, you will go with the market down to zero. But then the market moves in cycles, it will probably go up again, hopefully. Any more? Yeah. If you're looking at less volatile markets, you probably want to use different indicators. I'm not saying crossovers won't work. I'm just saying they won't capture big movements. Volatile markets, a crossover will 100% capture a big movement. The main reason why crossovers don't work on horizontal or sideways markets, we say, is because there's so many crossovers, because the market is literally doing this, you overall lose money. It works in volatile markets because the price movements are pretty drastic, just like Bitcoin, Ethereum. Yeah.
So do you think the crossover strategy for like trading currency?
The Forex market is a wild west. It's literally like crypto. I would say the crypto market right now is what the Forex market used to be like back in the 80s and 90s. Literally, it was like that. Can you use it in Forex? Let me show you one thing, just to blow all your minds. So I'll go on TradingView and I'll type in, what's your favorite currency pair? You have a favorite currency pair? All right. I'll do USD GBP. All right. So when I say horizontal market, the pound versus the dollar is basically horizontal, right? It goes from 0.69 to about 0.78. Okay. What Forex traders do is this. Okay, Forex traders literally do that, and they make the candles look like that. So have you seen on Instagram or over here, and they're talking about, oh, look at these candles, they're going up, they're going down, making so much money. Not making money. It's like what, 0.01, right? Instead, they basically use the house as collateral, put everything on the line just for one trade. Okay, it could work, but in my opinion, it won't. If they have a lot of money, then they're going to lose a lot of money. I think if you've got that much money, just go to Goldman Sachs and take 20% interest a year, rather than try and invest and trade it by yourself. And one last point, because we've still got some time. There's a difference between trading and investing. Okay, trading, if an investor tells you they're not a trader, they're literally lying. When you invest in anything, you place a trade to buy that financial asset or security. Okay, so they literally have placed a trade. So by definition, they're a trader. But just more conventional traders tend to be the ones that trade more regularly. So that might mean weekly, monthly. I tend to trade monthly and weekly. Or they could be a high frequency trader, which means the algorithms will trade every 30 seconds.